Alright, now let's take a look at part 2, which appears right here in the problem, and I'll read that so we have some familiarity with what we need to do. On July 23rd of the current year, Dakota Mining Company pays $4,836,000 for land estimated to contain 7.8 million tons of recoverable ore. It installs machinery costing $390,000 that has a 10-year life and no salvage value, and it's capable of mining the ore deposits for 8 years. The machinery is paid for on July 25th, 7 days before mining operations begin. The company removes and sells 400,000 tons of ore during its first 5 months of operations. Depreciation of the machinery is in proportion to the mine's depletion, as the machinery will be abandoned after the ore is mined. Okay, and we need to work on the journal entries to record this piece. All right, let's go back to some workspace in Excel where we can work on these. Okay, now you've seen this before from the earlier part. Let me just scroll a little bit so we have some room to work on part 2. Okay, well, we have a transaction on July 23rd to record. Okay, and on July 23rd we need to record the purchase of the mineral deposit. And the mineral deposit was $4,836,000. So let's record an asset called mineral deposit for 4,836, and this problem is somewhat simplified. We're assuming we paid for this in cash, which could be the case. I'll indent a little bit, and to follow proper form, we'll indicate what this transaction was for. It's to record the purchase of a mineral deposit. Okay, and we'll indent that to put it in proper form as well. Okay, then on July 25th, we buy the machinery, which the problem said was $390,000. Let's go back and look at that. There it is. Machinery, $390,000 with a 10-year life and no salvage value. So let's debit an asset count, property, plant, and equipment called machinery for $390,000. Credits in the same dollar amount, and like the cell above, it comes from cash, so rather than typing it, I'll just use the equal sign. And for those of you that may not know, an equal works with a number as well as text in Excel. That's why I could just simply reference cell C31. Comes out just fine. Now we would say this is to record the costs of machinery. Okay, and we'll indent that, put it in proper format. Alright, now on December 31st, we need to record the depletion, and we need to record the cost of that depletion on our income statement. So we have a depletion expense on the mineral deposit, and the credit will go to an accumulated depletion account relating to the mineral deposit. Okay, I'll indent that a little bit. And the purpose of this would be to record the depletion on the mineral deposit, but let's just leave it as to record depletion should be enough. Okay, so what's the dollar amount? Well, the dollar amount we know is going to be equal to the cost given in that cell right there, right? And then we need to divide that by the number of tons, which I believe was 7,800,000, and that determines our cost per ton. This is just one way to do it. Okay, so we'll have a cost per ton, and I believe for the current year there's 400,000 tons to be applied. and that would give us, format this, $248,000 as our depletion expense that we need to record. Now, let's make sure we have the facts in order. Yeah, the company removes and sells 400,000 tons during its first year. So we're using an activity basis, and they expected 7.8 million tons of recoverable ore. So we've done that correctly, and let me show that calculation again. The D30 divided by 7,800,000 is our cost per ton, which was 62 cents. You saw me calculate that. Then we multiply it times 400,000 to recognize how many tons were extracted or mined during the first year to come up what the depletion expense should be. All right. Now on 12/31/2005, we also need to record depreciation expense on the machinery. Okay. I will indent that in proper form. And then this one would be to record depreciation on the machine. Okay, if I can spell that correctly. We'll indent that. Okay, so now let's take the cost of the machine, and in this case we believe that we're using the same activity basis of how many tons divided by how many tons we expect to produce. So we have $390,000 cost. Let's do this the same way again. We'll take the $390,000 cost, and we're going to divide that by that 7,800,000 of total amount of tons of ore to be mined, and that calculates, if you will, a cost. Let me sort of put this out, a cost of the machinery per ton produced. It's 5 cents per ton, and once we have that, then we would multiply that times, let me hit the F2 so you can see the whole formula, equals the cost divided by 7,800,000 tons, gets us 5 cents per ton, times the number of tons that were mined during the year, which is 400,000. So we're using activity-based depreciation here, and we come up with $20,000. Now, we don't need the decimal places showing, so I'll hide that. And that takes care of the Part 2 entries. Now, there's also an analysis component. Let's read what that would like us to do. Describe both the similarities and the differences in amortization, depletion, and depreciation. Well, amortization, depletion, and depreciation, they're all similar in that they are essentially all methods that we use to allocate long-term assets to the proper accounting periods over the life of those assets, meaning they are being allocated over the accounting periods where there was a benefit derived from the use of those assets. Now, there are some differences. They're different in that they apply to different types of long-term assets. So amortization applies to intangible assets where we have a definite useful life. Depletion applies to natural resources. And depreciation, which is by far the most common, applies to plant assets. We can think of those as tangible assets, assets that have actual physical substance. One other point, amortization is typically computed using a straight line method, but the units of production method, which we're doing here, which is considered an activity basis method, is normally the one used when we're involved in depletion. Okay, thanks everyone. That takes care of part